Kenya has announced plans to raise up to $2 billion from the international capital markets in the next financial year. And the move by the government is aimed at funding the repayment of its 10-year Eurobond that's maturing in June 2024. Last week, in a media advertisement, the National Treasury, basically Kenya's Finance Ministry, invited expressions of interest from financial institutions to provide transaction advisory services for that proposed Eurobond. Now, remember, this is coming amid rising interest rates and a strengthening US dollar, and those two combined have made global financial markets fairly unattractive at the moment for raising capital. Domestically, too, the government is facing a whole host of issues in meeting its revenue target, with the IMF ruling out a restructuring of Kenya's debt. Now, speaking of Kenya's foreign commercial debt, yields on the country's $2 billion Eurobond due in 2024 have surged. They've risen as high as 19.73% today, the 25th of April. Here's essentially what you would have seen if you're tracking it since the start of the year. Compared to the lows of around 10.4% in January, yields have moved up by over 900 basis points, basically pushing it into distressed territory. Now, in part, concerns are centered around the state of Kenya's public finances. A fortnight ago, the country's president admitted the state is facing cash flow problems, and it isn't about to borrow in order to pay the salaries of civil servants, which were delayed.
He will not continue the old tradition of borrowing money to pay recurrent expenditure, to pay salaries. We are going to pay salaries from our own resources. We are going to carry out our recurrent expenditure using our own resources. And we have moved our fiscal deficit to 5.7%. Our target is to take it to 5% next year and 4.4% the following year, so that we can work within the parameters of the resources that we can raise as we grow our own tax revenue. I have also instructed the Treasury to look at all the taxes, to have a tax review of all the taxes. There are some taxes we certainly are going to reduce in the coming budget, because some of the taxes are punitive and they actually encourage more dodging than paying and compliance, so that we can make it much more easy for citizens, corporates, and all the people that work with us to comply.
Right then, Kenya's president there. The thing is, though, for years now, Kenya's debt service to revenue ratios have been flashing red, hovering around the 50% mark. Put another way, if Kenya was an individual, this would be the equivalent of you spending 50% of your net salary just paying off your debts. Over the next 3 years, interest costs alone, we're not factoring in principal payments here, just interest costs, they're going to rise from just under $5 billion to close to $6 billion. So the question then becomes, what exactly has gone wrong in East Africa's biggest economy? Let's find out. Mark Bohlund joins us now. He's a senior credit research analyst at Red Intelligence. Mark, good to have you on the program. So let's start with what the yield charts are telling us here. The 2024 Eurobond has been trending lower from last July. It hit around 21.6%, then went down to 10.4% in January. What has changed now to send yields soaring once again?
Thank you, Rama. Well, I mean, this is not just a development regarding Kenya. You've seen essentially a bifurcation of the market where the safer credits have seen their yields dropping. That's investment-grade credits, while the more stressed ones like Kenya, Egypt, and Pakistan have been selling off in recent weeks. So I guess there are different views what's driving this, but I think one of the factors is that investors in general were expecting a bit more relief or a bit more progress at the IMF World Bank spring meetings in April. Essentially some more financial aid for these countries to crystallize, but there wasn't frankly much of this. And I think this does explain a lot of the movement. And of course, in the case of Kenya, you also have the recent headlines with the delay in the public sector strikes, public sector salaries in April, and other developments which also have scared investors.
So when Kenya came to the market about a week ago and said, you know what, we're going to issue another Eurobond before June 2024 in order to pay off the note that is due next year, from the market's perspective, why would that be seen as a red flag?
I mean, I think this is still very early in the process. I think most people realize that Kenya won't be in a position to refinance this for quite a while, and as you say, they do have a bit more than a year before this bond comes due. So I don't think, personally, I don't see it as that much of a red flag. But of course, I think there is a concern that if they will be refinancing at the current high rates, that will actually exacerbate the problem, increase interest costs even further. And as you mentioned, I mean, Kenya's interest costs are already very high. I mean, they're among the highest in the frontier universe after well, Zambia and Ghana have gone down the way of debt restructuring already. I think Egypt has a similar level. So I think that is one of the reasons for the concern.
So Kenya's central bank governor, when he was at in Washington for the spring meetings, he's been very vocal, right, about expecting $1.2 billion in debt flowing in, assuming that, you know, we wrap up these discussions with the World Bank on a DPO. That's probably going to be $1 billion, plus a bit of syndicated loans also coming in, at least in the next 5 weeks. But does that really make a material difference to Kenya's debt service issues, though? Because that only takes reserves back to where they were in January, assuming the money comes in.
I think it will definitely help in the near term. You also have a loan from the IMF's new Resilience and Sustainability Trust that could be up to $1 billion. And that should help. And this is actually funds at very low interest rates. So this should help to reduce the interest on the cost. But as the market is now, and I think general market developments will remain very, very shaky. I'm considerably more pessimistic about the chances for Zambia, for Pakistan and Egypt going forward. And I think any credit event there in the next 6 months to a year will have repercussions also on Kenya. I mean, I think Kenya is in a very much better position, but of course the very high level of interest costs, close to 5% of GDP, will take time to reduce, and that will mean that the market is probably going to be too pessimistic about Kenya over the next year to refinance the 2020 bond, the full amount, without some kind of credit enhancement, a kind of policy-based guarantee from either the World Bank or the African Development Bank.
All right, then one last question for you, Mark, because I know we're running out of time here. But Kenya is also a fair bit behind on its domestic borrowing target for the year. We've seen, especially this year, bond auctions have been underperforming significantly. There's one, I believe it was last week. Kenyan government came into the market looking to raise about 30 billion Kenyan shillings. They only got around 6% of what they were looking for. A 15-year reopened note, the auction on that cancelled. From an external perspective, how concerned is the market about those developments?
And I think, well, there are anecdotal evidence that Kenyan investors are actually heavily invested in the Eurobonds. And of course, if you look at the yields you have now on the Eurobonds in the mid-double digits, well, 10, 12 to 15%, even higher for the 2024. Of course, as a Kenyan investor, this is going to be more attractive to you than the 12 to 14%, up to 15% that you have on the longer-term instruments in the domestic market. So I think these developments are essentially very closely connected. That in order to make the domestic debt attractive again, you need to have lower levels, lower yields on the Eurobonds.
And it puts the government in a catch-22, doesn't it? Because if you're going to have to raise rates, that also raises your debt service costs at the same time. So, it's a damned if you do, damned if you don't situation.
Yes, in a way. I mean, if you see, we're talking about levels of billions of dollars invested in the domestic money invested in the Eurobonds, and of course that reduces the amount available to borrow in the domestic market.
All right, we'll leave it there for the time being. Mark Bohlund, Senior Credit Research Analyst at Red Intelligence. Thank you very much for your insights.